Are you a professional pillow fighter? Or a 9-to-5 low-cost time travel agent? Or maybe real estate sales on Mars is your profession? It doesn't matter. Whatever it is you do, however complex or intricate, Monday.com can help you organize, orchestrate, and make it more efficient. Monday.com is the one centralized platform for everything work-related. And with Monday.com, work is just easier. Monday.com, for whatever you run. Go to Monday.com to learn more.
Got great ideas, but no idea how to build a website? Get Bluehost. Their AI design tool creates high-quality WordPress sites super fast. Whether you're a blogger, influencer, or launching a side hustle, Bluehost helps boost your growth with built-in marketing and e-commerce tools. Upgrade to cloud to get 100% uptime and 24/7 security to stay online all the time. Why wait? You've got the vision. Make it real. Visit Bluehost.com to get started.
Welcome back to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to take a look at how earnings season is performing. We just kicked that off last week. And then we're also going to take a closer look at a potential emerging market within the tech sector. But before we get into all of that, I want to give a quick shout out to Jay Rojas, a new patron on our Patreon. Thank you so much to Jay for your contribution. If you'd like to become a patron, please head over to the link in our show notes, patreon.com/investies, where you can contribute to our podcast. We will give you a shout out on an episode, and we will also give you access to Investies commercial free a day early before public release. Thank you all so much for your contribution. We finally kicked off Q3 earnings season. Now, this can get sometimes extremely confusing because we currently are in Q4. However, we are receiving all of the reports from the third quarter. So we have kicked off third quarter reports, and I'm excited. I love earnings season. I live for earnings season. This is like, I guess it's like football for guys or something, basketball season. This is my season. Earnings season always kicks off the second week of the new quarter. So right now we are in Q4. It kicked off last week. It always starts on a Friday, and it always starts with the banks. So as of last Friday and as of today, we have had banks reporting every single trading day. I'm happy to share that the banks are performing pretty well this earnings season. We're going to talk about what is the catalyst for their current performance. I think it's important for me to highlight that we get to see trends in certain sectors. So the beauty of hearing a block of publicly traded companies in the same sector share their earnings is that we get to compare them to each other in the same sector. So we get to see how macroeconomics are affecting each of the companies. And if we start to see a performance trend and we see a bank that falters and doesn't necessarily perform like the other banks, we can kind of see what is taking place, what the issue is within the company itself. When a publicly traded company announces their performance every earnings season, what we are typically looking for on a high level is either a miss or a beat. We've talked about this several times on the podcast in episodes prior, but just to give you a refresher, there is an analyst that is assigned to a specific sector or to specific publicly traded companies. They become experts in the sector. They then analyze all of the financial statements from the publicly traded company, and they determine a goal, so to speak, that the publicly traded company is expected to either beat or miss. Now, this goal is a goal that is for earnings, meaning their profit, or for revenue, what they initially bring into the company. So we are always looking to see, did they miss or did they beat on their earnings and revenue? So far, here's what we have from the bank sector. We have Wells that reported and they beat earnings. JP Morgan Chase beat earnings. Bank of America beat earnings. Charles Schwab beat earnings. Citigroup beat earnings. PNC Financial beat earnings. Morgan Stanley beat earnings. So they beat all of the profit expectations that analysts were expecting for them to hit. This is all positive news. It does not necessarily mean that they are more profitable than the last quarter or performed better than the last quarter. It means that the analysts analyzed the economy and analyzed all of their financial documents and gave them the target, and they beat that target. So on a high level, this is how we measure a publicly traded company. So far, as I mentioned, all of those banks have beat up until this point. We do have a couple that missed on their revenue expectations, but all in all, the banks are actually performing relatively well. So the next question is, what is the catalyst? Why are these banks performing well? What is the through line? When we see a similar performance in a sector, we can most likely expect for them to have the same catalyst. And so the catalyst that we are attributing the bank's performance to is the stock market. Banks have all beat earnings because of how well the stock market has performed. That is the catalyst for beating earnings expectations in the banking sector. It's really important for us to understand that when we make our deposits into our own banks, they are not just holding on to our money. They are actually taking that money and using it to generate more money. They are using it to increase their earnings. They are using it to increase the value of their own stock. And so they have all benefited from the growth of the stock market since the start of the year. You know what? Actually, since longer. Let's look at the last 12 months. If you remember, in October of last year, we had a correction in the stock market. The stock market came down for a bit, and then it has continued on an upward path since October. While we tend to look at year to date on this podcast, we really haven't looked at the growth that has taken place over the last 12 months. So let's go ahead and do that now. In the last 12 months, the Dow has grown 30%. The S&P 500 has grown 40%. And the NASDAQ has grown 45%. I tell you this all the time, but on average, we can expect for those indexes to grow anywhere from 8 to 10%. We are seeing astronomical growth in the last 12 months, and the banks have developed strategies to buy into that growth and benefit from it, and we should be doing the same. We need to make sure that we are consistently investing and buying into the stock market, and not just depending on the minimal return that the banks give us, most especially as inflation continues to increase. Let's take a look at inflation and how it did for the month of September. Not only did we kick off earnings season last week, but we also received CPI data, which tracks inflation. It measures the changes in prices paid for goods and services over a period of time. So it measures inflation from the consumer's perspective. CPI stands for Consumer Price Index. We saw CPI increase by 0.2% for the month of September. This does mean that inflation does continue to increase. It's not increasing as rapidly as it once was, but it is still increasing. It increased higher than analysts expected. Analysts were expecting a 0.1% increase. So we came in double that. And then year over year, our CPI came in at 2.4%, which was down from year over year in the month of August, but still higher than what analysts were expecting. These numbers do show that inflation is persistent. And since this data has been released, we do have several analysts that have finally come out to say that a 50 basis point interest rate decrease could potentially be a bigger problem. I have been saying that the entire time, okay? It seems obvious to me. At one point, I thought maybe I still have a lot to learn, but as I'm watching this unfold, I am realizing that my perspective and what I was seeing could be, in fact, accurate. I wanted to share some news that is currently developing in the tech sector. Just this week, we have witnessed Amazon, Google, and Microsoft all strike deals with nuclear energy power plants. Why is big tech turning to nuclear power plants? Well, it takes a lot in order to process AI technology. With new applications like OpenAI's ChatGPT and other ChatGPT applications, it requires more energy than we are able to produce. Not only do we need to produce more energy to support AI, but we also need to make sure that we are producing cleaner energy. And so producing nuclear reactors creates zero carbon emissions. A lot of these companies are on a path to net zero emissions. And so this is a way to not only generate more energy, but to generate clean energy. One of the problems that we face here in the United States is that we currently do not have a producer of what is called a small modular nuclear reactor, also known as an SMR. The Biden administration has made a big push for clean energy production, funneling billions of dollars into that sector. We also just heard from U.S. Energy Secretary Jennifer Granholm saying that $900 million of new funding is now available for anyone looking to deploy SMRs. She says, and I quote, "We want these data centers to be built in the United States for a variety of reasons, including national security reasons. We need additional power to be able to do that, and we want that power to be clean power." I want to make sure and highlight that the technology sector is one of the biggest contributors to our economic growth in this country. It is going to be so important that as we start to create new technologies, that every piece that is needed for that technology to excel be produced and harbored in the United States. When we invented the chip that processes our phones and our cars and so many things, we outsourced that production to Taiwan. And now we're facing serious implications with not only the loss of revenue for the production of the chip, but someone else is in control of that chip, despite the United States having invented that chip. This also exposes a vulnerability for national security. And so as AI technology advances, it is going to be very important that we maintain the production for the AI acceleration here in the United States for job growth. It is not enough that we are just the inventors, but it is detrimental to the United States that we remain leaders in that space. The recent deals that Amazon, Google, and Microsoft closed for the production of SMRs are with American energy companies. It is expected that the need for SMRs is going to grow 85% within the next 15 years. Now, it is expected that we will not see full SMR production until 2030. Out of the three companies, Amazon was the only one to close a deal with a publicly traded company. They have agreed to invest $500 million in Dominion Energy in order to begin the exploration of the development of SMRs. Dominion Energy is currently trading at $60 per share. It is up 4% since the news of the company as of right now. It did once have an all-time high of $85. This was back in 2023. We did see a significant drop when the stock market was coming down a year ago in October, like we just talked about, but it has since recovered 50%. Of course, it's not fully recovered, trading at $60 per share. If we are going to take a look at Dominion Energy as a potential investment, it is very important that we manage expectations because Amazon made an investment for the exploration to potentially develop an SMR. It is not for the actual development. So that is still very early stages of the space. Remember, we don't have a company in the United States that builds SMRs. And so this is a new area for us to explore. An investment in Dominion Energy, specifically for the reason of the development of SMRs, is a speculative investment, meaning that it is very risky. We don't know how it will unfold. Dominion can fail and not meet expectations on being able to deliver what we are expecting for it to deliver. So that's always very important. I also think it's important for us to explore these as potential investments as we become more seasoned investors. It's fun to take a look at all of these companies. Who would have guessed that NVIDIA was going to be the top chip maker of the United States of America once we started to focus on funneling that business here in the United States? I hope you enjoyed this week's episode of Investies. I'm your host, Linda Garcia. Investies is a Cosmic Standard and In Luz We Trust production. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
If you're a facilities manager at a warehouse and your HVAC system goes down, it can turn up the heat, literally. But don't sweat it, Grainger has you covered. Grainger offers over 1 million industrial-grade products for all your operations, including warehouse HVAC maintenance. And even better, they offer access to experts and fast delivery, so you and your warehouse can both keep your cool. Call 1-800-GRAINGER, click Grainger.com, or just stop by. Grainger, for the ones who get it done.